We're really enormously fortunate to have with us today one of the United States and the world's really leading experts in this area. As you may know, this is our 70th anniversary at SIPA, and as we were thinking about our priorities going forward, we recognized we had really fundamental strength here around capital markets, international finance, and emerging markets, and we send so many of our students into financial institutions and central banks and financial regulators around the world. I think we have more than 100 alums in the New York Fed, if I'm not mistaken, as one example. Recognizing and wanting to build on that foundation, we launched just recently our Central Banking and Capital Markets Initiative. And today's discussion is really part of that. And after our distinguished speaker, our senior fellow and professor who teaches here on monetary policy and central banking issues, Trish Moser, will lead a discussion with our distinguished guests. We have today a special treat, which is to hear from Simon Potter, who's Executive Vice President and Head of the Markets Group at the New York Federal Reserve Bank. He's also manager of the System and Open Market Account for the Federal Open Markets Committee. And he'll explain to us what that means, I think. It's not, it sounds enormously important, but I'm not sure I know exactly what it means. He brings to this really incredible depth of familiarity on markets and on economics, having started his career as a professor of economics and has taught at UCLA, at Johns Hopkins, at NYU, and at Princeton. I hope one day we can add Columbia to that list. He earned his undergraduate and master's degree from Oxford and a doctorate from the University of Wisconsin. And he's here to discuss today the subject of money markets after liftoff, assessment to date, and the road ahead. And after his remarks, he's generously agreed to engage in a discussion with Patricia Moser, who is indeed leading SIPA's initiative on central banking and financial policy, and is also a longtime veteran and expert from the New York Fed. We're particularly grateful to have this talk today as we move forward in the early days of celebrating our 70th. Thank you very much for being with us.
Okay. It's an honor to speak to you today as part of the 70th anniversary, I guess it's right behind me here, of the School of International and Public Affairs at Columbia. And I'm really glad that our former colleague and longtime friend Trish is here and is going to be asking me tough questions. Is that right, Trish?
Yes.
All right. The program's offered by SIPA, which aim to train young leaders to address the world's most pressing public policy programs, are especially relevant to the mission of the New York Fed. And many of the members of the bank's markets group are alumni. As you said, 100 within the bank as a whole, but many of the leadership in the New York Fed markets group have studied here, and thank you for that. So I'm here to offer a few thoughts on money markets and the implementation of monetary policy. Because of the large size of the Federal Reserve's balance sheet, the staff at the Federal Reserve spent the past several years developing a new and innovative framework to control money market rates, and working to increase the amount of data we receive about trading in those markets. So you all have a little chart pack on your seats, which will have some of that. In my remarks today, I will review the performance of this new framework and discuss key insights from those new data collections. As always, these views are mine alone and do not necessarily reflect those of the New York Fed or the Federal Reserve System. So why are we following a new approach to implementing monetary policy? Before the financial crisis, the Federal Reserve followed a well-worn playbook for monetary policy implementation that was based on scarcity of reserves. Reserves left at the Federal Reserve earned 0% interest. As a result, to achieve the FOMC's desired level of the federal funds rate, the open market desk at the New York Fed, I'll just call that the desk going forward, estimated the amount of reserves to add or subtract that would intersect supply and demand at the target interest rate directed by the FOMC. All else equal, if the desk wanted interest rates to go up, it slightly reduced the amount of reserves. If it wanted rates to go down, it slightly increased the amount. Back then, a typical day on the desk, which Tris will remember, focused on forecasting the demand for reserves created by reserve requirements and other sources, and projecting autonomous factors affecting reserves. With very small amounts of excess reserves in the system, there was a straightforward relationship between rates in a range of money markets. Thus, the desk was able to target a rate in one part of the unsecured market by conducting small secured operations as needed with primary dealers. Since the financial crisis, the environment has changed in two important ways. First, by the end of 2014, following the large-scale asset purchase programs, the Federal Reserve's balance sheet was funded by about $3.1 trillion in liabilities other than Federal Reserve notes, which were mostly in the form of reserves in excess of the amount banks were required to hold. In contrast, there were only $64 billion of non-Federal Reserve note liabilities in June 2007, of which only about $2 billion were in excess reserves. As a result, reserves are now anything but scarce. Second, Congress granted the Federal Reserve an important new tool, the authority to pay interest on reserves, or IOER. In many countries, and in theory, a standing facility that pays IOER provides a floor on interest rates. The reason is simple. If a private counterparty can invest cash at the central bank, then given the safety and convenience of this investment, it will dominate any other overnight investment at that interest rate. Further, if banks can acquire funds in the wholesale market at rates below IOER, then competition for those funds will bid up these rates close to that paid on reserves. The Federal Reserve instituted interest on reserves in late 2008, and the interest rate on reserves turned out not to be a floor. Market interest rates fell significantly below it. With the large levels of excess reserves in the system, certain institutional aspects of money markets in the United States, including bank-only access to IOR, credit limits imposed by lenders and other impediments to market competition, and the costs of balance sheet expansion, that's a long list there, but it's easier to read it in the text that I have, appear to create fictions that made interest on reserves act more like a magnet that pulls up short-term interest rates than a firm floor beneath them. Thus, in considering how to implement policy normalization, the Federal Reserve evaluated a variety of ways to increase competition for funds among borrowers and thereby improve the control provided by interest on reserves. The Federal Reserve initially considered an approach to policy normalization that was based on a combination of term operations and asset sales or redemptions aimed at making reserves sufficiently scarce so that once the FOMC decided to tighten monetary policy, this tightening could be implemented using interest on reserves within a framework that was otherwise similar to that used before the crisis. As part of this approach, the Federal Reserve acquired a new set of reverse repo counterparties, including money market funds and government-sponsored enterprises, in addition to the primary dealers with which it had traditionally transacted. These new counterparties were major investors of cash in overnight markets and had capacity to facilitate the draining of substantial reserve balances if offered attractive term investments with the Federal Reserve. In addition, the Federal Reserve developed a term deposit facility to drain banks' reserve balances. This playbook of draining reserves back to reserve scarcity to support the transmission of interest on reserves into the market rates is standard among central banks. If policymakers had chosen to do so, the Federal Reserve could have made such a term reserve draining approach work to help control money markets rates in the United States. So why did the Federal Reserve not follow the approach of large-scale reserve draining? As the balance sheet continued to grow as a result of asset purchase programs, it became apparent that such reserve draining operations would have been very large in comparison to the size of private money markets. As a result, they probably would have had lasting effects on the structure of those markets, for example, by reshaping the structure of term money market activity according to the structure of the Federal Reserve's operations. These lasting effects could have been especially large if the balance sheet did not run off quickly. For this reason, the Federal Reserve instead pursued offering an overnight investment opportunity that could, with sufficient capacity, intensify competition in money markets and without necessarily draining reserves, enhance the transmission of interest on reserves into other overnight money market rates. This approach entailed a twist on a traditional Federal Reserve tool, reverse repos. Instead of running quantity-based term operations aimed at altering reserve levels, the desk would run interest rate-based overnight operations aimed directly at influencing market rates. A number of operational features were required to implement such an overnight reverse repo, or overnight RRP facility, as I'll say throughout the rest of the speech. It would need same-day settlement. The operation would need to be run predictably every day and as late in the day as possible to give lenders time to bargain with other counterparties using the outside option of investing with the Federal Reserve. An appropriate spread below interest on reserves will be required to ensure that the facility neither induced large changes in the structure of money markets nor lost the ability to support interest rate control. And the operations would need enough unused capacity that lenders could credibly propose to leave borrowers that did not offer an adequate interest rate. The approach works in theory, and with the support of staff across the Federal Reserve System, a theoretical framework was developed around money market rate control through the use of this framework. The overnight RRP facility was also tested for more than 2 years. This theoretical and empirical examination gave the Federal Reserve confidence that it could effectively raise rates when the time came, while limiting undesirable effects on financial market structure, and also ensured that additional term tool operations were available if the combination of the overnight tools, interest on reserves, and overnight RRP was not sufficient to provide interest rate control. At this point, you might have a question. From late 2008 to late 2015, the federal funds rate traded below the FOMC's target range of 0 to 25, well within the FOMC's target range of 0 to 25 basis points. Shouldn't this have been conclusive evidence as to the ability of the operational framework to provide sufficient control of interest rates? Unfortunately, the answer is no, because there are natural features of the financial system that likely provide support to interest rates near the zero lower bound. These features include the availability of physical cash and a behavioral aversion by some money market investors to investing at negative rates, and also encompass certain unique features of money markets in the United States, such as legal and regulatory incentives applicable to money market mutual funds and the ability of government-sponsored enterprises to leave unremunerated deposits at the Federal Reserve. As a result, while the pre-liftoff testing suggested the tools were likely to work well, it wasn't possible to determine with complete certainty the extent to which market rates were driven by the tools or by zero lower bound effects. To summarize my conclusion about the performance of the operating framework to date, I'm extremely pleased with what we've seen so far. In discussing why I view the framework as effective, it's helpful to start by explaining what it means for the tools to work well. I think about this issue through 3 lenses: interest rate control, avoiding unintended impact on the structure of the financial system, and avoiding financial instability. I'll touch on what each of these mean, and then I'll review the quantitative evidence since liftoff and how well things have gone. Clearly, interest rate control is a paramount objective. It is of great importance that the public is confident that the federal funds rate will be, on average, over time within the target range set forth by the FOMC, and that other money market rates will continue to move closely with changes in the federal funds rate. This way, expectations for the FOMC's future policy stance will be properly incorporated into the term structure of interest rates, and thereby appropriately affect broad financial conditions and the broader economy. It's not necessary that the effective rate stay within the target range each and every day. Before the crisis, there was usually a bit of variability in the effective rate, owing to limitations on the desk's ability to achieve completely precise daily forecasts for reserve demand. Now, as you know, the FOMC sets the target as a range, not as a point value. The federal funds rate can vary within this range, and it could even move outside that range on occasion without materially affecting the economy. We have instituted a data-driven, cross-market framework for evaluating interest rate control. In unsecured markets, we gather daily transaction-level data through a new Federal Reserve statistical collection called the FR 2420. Monetary control does not stop at the effective federal funds rate. The Federal Reserve also wants to ensure that the stance of monetary policy is passed through into other money market rates. For example, we evaluate such transmission into the Treasury tri-party repo market, the market in which overnight RRP is conducted, by collecting similar trade-by-trade data from clearing banks. A second lens for evaluating the operational framework is the extent to which it avoids creating incentives that might result in undesirable changes in the structure of the financial system. This means that the framework shouldn't have lasting unintended effects on how people invest their money or on how financial institutions interact with each other. The Federal Reserve is operating the overnight RRP on a temporary basis, primarily because the balance sheet is currently large. The FOMC's policy normalization principles and plans make the temporary nature of the overnight RRP clear by stating that it will be discontinued when it's no longer needed to help control the federal funds rate. This intention was noted again in the minutes to the January FOMC meeting. As a result, we expect that firms would not make structural changes in how they operate in response to the overnight RRP, to avoid the cost of unwinding those changes when it is continued. The intention of the FOMC to impose an aggregate cap on the overnight RRP, as described in the January minutes, will mitigate this risk. The third lens for evaluating the framework is the extent to which the framework avoids augmenting risks of financial instability. In particular, the framework shouldn't create a risk that in times of stress, money market lenders will rapidly disintermediate their usual counterparties and come to the Federal Reserve instead, such as through the overnight RRP facility. Of course, flight to quality effects have existed in financial markets long before we put the new framework into place. What I'm referring to is a situation where the framework facilitates these effects or makes them larger. We address the risk of sudden surges in take-up in a couple of ways. For example, we can employ vigilant market monitoring to detect any such shifts and allow the FOMC to formulate a response. We can also use per counterparty caps and can use an aggregate cap. Now let's discuss what the data tell us about how well the framework performs. So now that sheet of paper you have on your sheets will be useful to look at. The distribution of traded rates in the federal funds market, shown in Figure 1, essentially made a parallel shift higher after liftoff. These data are drawn from the new FR 2420 data collection, and they show an average over all days from liftoff to this past Wednesday, leaving out December 31. Nearly all trading occurred within the new range. It's normal for there to be a little bit above the range, suggesting that our framework was broadly effective in moving traded rates upward. Because traded rates moved upward in this way, we have so far achieved an excellent level of control over the federal funds rate. Since December 17, the day after the FOMC meeting, the effective federal funds rate, calculated under its current methodology as a volume-weighted mean, has traded within the FOMC's new 25 to 50 basis point range on all but one day. And I'll come back to that. This is shown in Figure 2. Let's consider the calculation of the effective rate for a moment. Last year, we announced some changes to the calculation, the most significant of which is that starting in March, we will switch to calculating it as a volume-weighted median, using data drawn from the FR 2420 data collection, rather than the volume-weighted mean using data provided by the Fed funds brokers. So you see your footnote to Figure 2. It says how that chart is constructed. Our recent experience has confirmed the expectation that transition to the median in March will result in little overall impact on the level of the effective rate over time. Figure 3 shows a time series of the mean and median rates computed from the FR 2420 data. As you can see, they remain quite close to one another. The FR 2420 data also allows us to examine closely the distribution of traded rates in the overnight euro-dollar deposit market. The euro-dollar market is considerably larger than the federal funds market. According to FR 2420 data, on average, in the last 2 months of 2015, there was $233 billion of overnight borrowing in the euro-dollar market. In contrast, over that same period, there was $70 billion overnight borrowing in the federal funds market. We observed a similar response in yields in the eurodollar market as we did in the federal funds market, with a distribution of traded rates making a parallel shift upward of about 25 basis points, as shown in Figure 4. We can look into that further by examining the overnight Treasury repo market. Rates on these transactions, as reported by the tri-party clearing banks, shown in Figure 6, exhibited a similar shift upward. It also looks as though the increase in the federal funds rate passed through effectively into term money market instruments. Figure 7 shows the recent progression of rates on 3-month Treasury bills and 3-month commercial paper. Also shown for comparison is a 3-month overnight index swap quote for the effective federal funds rate. All of these rates rose going into the December FOMC meeting, which makes quite a bit of sense given that most market participants expected the FOMC to tighten policy at that meeting. Treasury bill yields rose a bit less than other rates on instruments of comparable term and now trade at yields somewhat below the overnight RRP rate. Now, I mentioned earlier that the Fed funds traded within the target range on all but one day. Let's talk about that day, which was the year end. On that day, the effective Fed funds rate, calculated as a mean from the FR 2420 data, printed at 20 basis points, 15 basis points below its prior day value, and 5 basis points below the FOMC's target range. The median dropped a bit more by 20 basis points to a level of 15 basis points. In addition, as shown in Figure 8 and Figure 9, the dispersion of traded overnight rates in federal funds and eurodollars increased on that day with a substantial amount of trading activity at fairly low rates. These year-end effects were transitory, and the level and distribution of rates in the federal funds and eurodollar markets returned to pre-year-end conditions on the following day. Although the effects were transitory and did not adversely affect policy implementation, spending a bit more time on this episode can contribute to our understanding of money market relationships. Why did we see the year-end drop in unsecured rates? Recall that the framework functions by creating opportunities for investors to borrow funds in money markets to earn interest on reserves whenever there are significant differences between market rates and the interest on reserves rates. On quarter ends, the actual and perceived marginal balance sheet costs of a number of depository institutions increase as they publish financial statements and calculate regulatory ratios. These increased balance sheet costs mean that depository institutions borrowing funds in money markets to earn interest on reserves must do so at a lower interest rate to account for these costs. Further, the reduction in balance sheet capacity can temporarily lower the bargaining power of lenders, again allowing borrowers to obtain funds at lower rates. Many lenders in the federal funds and eurodollar markets with access to the overnight RRP facility responded to these lower rates by increasing their use of the facility, as shown in Figure 10. However, other lenders remained in these markets, including those without overnight RRP access, those who received funds late in the afternoon after the overnight RRP operation had already occurred, and those for which overnight RRP was not an acceptable substitute. On this last point, for some institutions, the overnight RRP is an imperfect substitute to lending in private unsecured markets because, in the tri-party repo system through which the overnight RRP is settled, cash is not returned at maturity until late the next day, whereas in private unsecured markets, early return of funds can be negotiated. Turning to the second lens I noted earlier, we have achieved excellent control while avoiding any unintended changes in the structure of the financial system. Figure 11 shows RRP take-up over time, grouped by counterparty type. Take-up both in aggregate and at the counterparty type level has been stable since liftoff. Among the money funds shown in the figure, government-only funds make up more of the demand on typical days, with funds that can invest in a broader universe of money market instruments, called prime funds, accounting for the balance. This has also been stable since liftoff. In addition, as shown in Figure 12, lending volumes in secured and unsecured money markets have been stable, suggesting the Federal Reserve's facilities have not displaced activity in the private sector. Figure 13 shows activity in unsecured markets by selected lender types. This shows that post-liftoff, the composition of activity in these markets also appears to have been stable. Finally, I'd like to speak briefly to the third lens, avoiding financial instability. As you know, there's been quite a bit of volatility and risk aversion in financial markets lately, and there's been no corresponding surge in overnight RRP demand. This continues to be an issue the FOMC is thinking about closely, as reflected in the January FOMC minutes. We have learned a lot about the structure of our operations from our experience with liftoff. I will discuss a few of my observations. Let's begin with quantifying the aggregate capacity limit. At the December meeting, the FOMC directed the overnight RRP's capacity be limited only by the value of Treasury securities held outright in the system open market account, which are available for such operations. So to go to the earlier question, that's the version of where we hold all those securities. That's the account. Okay, as a result, in practice, the overnight RRP is currently being run with an aggregate capacity limit of around $2 trillion, which is far in excess of typical daily demand and well above the $300 billion capacity limit the facility had had since September 2014. As the FOMC made clear in the minutes to its March 2015 meeting, this elevated capacity was intended to ensure a smooth liftoff, but the absence of an aggregate cap is only temporary. This is why the recent January minutes include a discussion of when and how it will be appropriate to reinstate an aggregate cap. So what have we learned about the appropriate level of the cap? It seems likely that having a very elevated aggregate capacity was helpful in controlling market rates initially, perhaps because it showed the FOMC's commitment to achieving interest rate control. But it's unclear exactly how much available capacity or headroom is needed to maintain such control. By way of background, determining the appropriate level of capacity involves striking a balance between the lenses I discussed earlier. Imposing a limit on the facility's capacity reduces the extent to which there can be disruptive surges of funds into the facility and to the extent to which private sector investors can change their lending patterns by using the facility. Thus, such a limit helps avoid financial instability and unintended effects on the structure of the financial system. However, a limit that is perceived as likely to bind weakens our control of interest rates, because when demand exceeds capacity, the interest paid on the overnight RRP facility is determined by an auction and is likely to be below the offering rate, thus reducing the efficacy of the facility in supporting the Fed funds rate. Our recent experience suggests that having reasonably high aggregate capacity can help improve control without necessarily encouraging greater use of the facility. When that capacity is great enough, money market lenders are confident they will be able to place funds with us at the administered rate, even on financial statement reporting dates. That confidence empowers them to demand rates from their borrowers that are above overnight RRP offer rates. Conversely, when the capacity is perceived as low, lenders worry they might not be able to place all their funds at reasonable rates. This means they might accept relatively low rates in money markets. In addition, because of switching costs and other frictions, as well as risk aversion on the part of lenders, rates can decline days or weeks ahead of a date on which the overnight RRP is anticipated to reach its capacity, to levels so soft that lenders reallocate funds to the overnight RRP. So having a high capacity can actually reduce overnight RRP take-up. But as I mentioned earlier, it isn't clear exactly how high the capacity needs to be to achieve the confidence of which I speak, and the benefits of high capacity must be carefully balanced against the benefits of a tighter aggregate cap in terms of avoiding financial instability and unintended effects on the structure of the financial system. Looking at the recent data, it's hard to precisely identify the extent to which the very high capacity relative to the previous limit of $300 billion helped to facilitate control beyond instilling confidence, as I mentioned earlier. One tentative indication that high capacity may be playing an important role is that unsecured rates appear to have settled in about the same position relative to interest on reserves as before liftoff, even though one might have expected the widening in the interest on reserves overnight RRP spread and the lower support from the zero lower bound to result in some downward shift. The overnight RRP also has a per counterparty cap, which was and is $30 billion. It seems that the current level of the per counterparty cap was also adequately large for perceived individual headroom, thereby supporting lender bargaining power. Figure 14 shows summary data on how frequently we receive large bids in our operations at the overnight RRP and term RRP facilities. As you can see, we rarely see bids of more than 10 billion, and combined individual counterparty usage across overnight and term operations has never exceeded 30 billion. Recently, we learned a bit about the term RRP operations. We've been conducting these over quarter ends as a way of providing additional RRP capacity. Additional capacity is available because term RRP operations are subject to a separate overall size limit and because there's no per counterparty cap in those operations. Counterparties appear to regard these as close substitutes for no overnight RRPs, and as shown in Figure 5, we've typically seen the overall RRP take-up across overnight and term RRP has been fairly stable across quarter ends. At this past year end, there was essentially no take-up at the term RRP operations. The reason is that the aggregate and per counterparty caps were sufficiently high that market participants were confident that they would not bind, and also because we conducted the term operations without any interest rate premium relative to the overnight operations. At prior quarter ends, term RRPs were typically offered with maximum bid rates a few basis points above the overnight RRP rate. The year-end experience suggests that market participants generally prefer overnight RRPs to term RRPs if they offer the same rate, and that if decide adequate control over money market rates can be attained without term RRPs, as long as there is adequate overnight RRP capacity. Compared with the relative calm of the pre-crisis period, money markets have recently gone through a sustained period of substantial change. Some of these changes are the result of regulations to improve the safety and soundness of the financial system. Others relate to business model enhancements, and of course some relate to Federal Reserve activity. The Federal Reserve continues to collect data on the structure of money markets to determine whether any changes are needed in its operating framework to ensure that its objectives continue to be met. We are continuing to watch developments in as business models adapt to the numerous changes in bank regulations introduced over the past few years. We're interested in the extent to which these business model changes impact the structure of money markets and thereby affect the form of monetary policy implementation. For example, we are monitoring developments in bank behavior that could have implications for the transmission of monetary policy into market rates. Thus, we are paying close attention to the behavior of foreign banks on financial statement reporting dates. We're also keeping a close eye on how domestic banks continue to respond to enhanced requirements on non-operating deposits, which for some institutions are fairly large relative to the size of their reserve holdings. Should these business model changes increase the spread banks demand to borrow funds in money markets to earn interest on reserves? Or should business model decisions apparently related to regulatory changes alter broader dynamics in money markets? This could result in upward pressure on overnight RRP take-up over time. We also are paying close attention to developments in the money market mutual fund industry and their potential impact on policy implementation. The SEC recently announced new regulations for these funds aimed at enhancing financial stability. One important feature of these new rules is that government-only money funds receive different regulatory treatment than prime funds, possibly making government-only funds more attractive for some institutional investors. If the assets under management in government-only money funds were to grow significantly, that could put upward pressure on overnight RRP take-up, since most fund managers consider the facility to be a government investment. As I noted earlier, we would not want to see growth in government-only money funds if it were predicated on a mistaken impression the overnight RRP would be around indefinitely and with high capacity. Also, if assets under management in prime funds were to decline sharply, this could possibly lead to less efficient transmission of monetary policy. To summarize, in the period since liftoff, we have achieved excellent control over the effective federal funds rate, and we've done so while avoiding unintended effects on the financial system or financial stability. The policy rate increase has passed through to other money market rates, suggesting that the increase is affecting broader financial conditions as expected and intended. We still have a lot of work to do, both to observe ongoing structural changes in financial markets and to formulate and implement any necessary response in the Federal Reserve's monetary policy operations. I believe we have thoughtfully considered these uncertainties, and I'm confident we have the appropriate policy tools available to respond as necessary to them. Thank you.
So Simon, I want to add my thanks to Merit for coming today to talk about this. and what the Fed is doing in this unique, historic time period. Massive balance sheet, trying to get off zero interest rates. I know from
Which
past
we did.
experience, which you did.
Yes.
Which you did. And how much work was behind that. I have, given my history, I know what a massive amount of work.
So it is true that in most countries in Europe, particularly where the ECB operates, that their deposit facility is effectively a perfect floor. So my counterparts there have a somewhat easier time with control if they're trying to look at the lower end. In the US, the UK, and Japan, there are more non-banks involved in money markets. So in all three of those countries, you will see the unsecured rate frequently trade below the interest on reserves. That's true in the UK, it's true in Japan, and it's definitely true in the US, where actually the presence of non-banks is really large. So this whole framework that I've described, and I spent a long time on overnight RRP, the whole framework is still premised on interest on reserves. So last week, the usage of the overnight RRP went down to about 30 billion. And you might be thinking, well, how did the Federal Reserve keep interest rates high with just usage of 30 billion? It's because everyone in private markets was effectively competing into the payments are offered on interest on reserves. If the overnight RRP goes from 120 billion to 30 billion, nothing else changes. That's 90 billion that appears as interest on reserves, which will earn the 50 basis points. Competition in the money markets will then distribute that between lenders and borrowers. What the overnight RRP does is it intensifies that competition, and as I noted it in the remarks, its actual usage can be quite low to achieve it.
So it's about the rate as opposed to the quantity.
It's all about the rate. Yeah.
So here's a slightly more speculative, a tougher question. So the first 25 basis points, the FOMC raised the target to 25 to 50. As at some point, the FOMC continues to raise the target range, and the gap, if you like, between those who get interest on reserves and those who don't gets bigger. And particularly those who actually get no interest on their, remunerated on their reserves. They don't get any, they're basically ineligible for interest on reserves. Wouldn't that make it harder to hit the target? Or hit the target range every day? And if I'm wrong about that, why am I wrong?
That's a good question. That's why we spent some time going over the year end. So the GSEs are the largest supplier of funds into the Fed funds market. That's the Federal Home Loan Banks who do that, not Fannie and Freddie. And they've had a choice for quite some time. When money market rates were low, suppose they were 3 or 4 basis points, they could just leave their cash at the Fed and get zero. The Fed is a nice, safe place to leave your cash. And it's in your Federal Reserve account, so it's available for you to use anytime you want, just like a nice checking account. Now, they can go into the overnight RRP and put their money there if they're not happy, if they're seeing market rates of, say, 12 or 13 basis points. And the overnight RRP now offers 25. However, if they need that money early the next morning, then the overnight RRP is not a very useful choice for them. So at that point, they've got to decide, do I want to get the money back early and get 12 to 13 basis points, or do I want to leave it in my Fed account? At 12 to 13 basis points or 15, and you can see it in the charts for, if you look at chart 8, you can see the 25th percentile, the 50th percentile with 15 basis points. At that point, you say to yourself, well, I'm going to accept that rate because I need the money back, and the overnight RRP doesn't do that for them. So you might expect that the phenomenon we saw on the year end will be reflected at quarter ends going forward, when the amount of balance sheet available gets smaller and the competitive dynamics change, as I described. So that would lead to this occasional difference where we're not necessarily getting the effective rate in the range. However, we look at a lot of data here, and if you look at what we were aiming to do, it still worked exactly the way we wanted it to do on December 31st. So when people had acquired, the balance sheet capacity was available on Monday, January 4th, they're in the money markets and they would not accept a bid. that was below 25 basis points. And you can see in figure 10 the big impact there of the usage of the overnight RRP went up by 200 billion. It just ran down the next day. So in terms of the point of the speech, which was it's not reserve scarcity, it's not reserve draining, the day that in some sense we had least control of interest rates was the day that we did the most reserve draining. The days when we have the most control in this interest rate directed one are when there's no big change in the liability structure of the Fed. It's just the competition, the private sector's doing it for us.
So do you think then that there's a risk, or this is my following, do you think there's a risk then that if a wider spread induces a bit more of that the quantities may end up bigger in the future?
We've only seen it, as I said, on the financial reporting dates, the quarter ends. On the surveys that we've done, the analysis that we've done, it seems unlikely that we would see a bigger drop-off. We're not that far from the zero bound, and really you're talking about, is there any uplift from the zero bound still? Because as you can see in figure 6, in the repo market, we're effectively providing a very firm floor. I find it hard to believe that we would see a big drift down. Now, that said, there are things about money markets that we're still trying to understand. When we did some testing at the end of 2014, we temporarily increased the rate on the overnight RRP. We moved up rates, which was very good for this framework. We felt confident. And then some of the rates didn't move back down. And we don't have a really good understanding for how that bargaining competition goes on. There are also lots of other forces in money markets that could affect where the Fed funds and other rates trade in the range.
So thank you. So one last question for me, and then I'll open it up for folks in the audience to ask questions. You mentioned toward the end that you are looking really closely at the impact of regulatory changes, other structural changes in the financial system on how the reserves markets and the other money markets are working. You mentioned two in particular, money fund regulation and the capital cost, basically, of how expensive more expensive balance sheet is because of higher capital requirements. Have you looked at the impact of liquidity regulation, which I would think could be important here, in particular things like the LCR, the liquidity coverage ratio, and all of those new international liquidity regulations?
So there's a lot of regulatory changes. And we're interested in how financial institutions react to that. So it's really their behavior in reaction. So those changes are to make the financial system safer and sounder. There's been a whole range of them. There's been a lot of other changes in business models not induced by regulatory changes. That has big effects in money markets. For example, some of the GSEs decided not to transact in the unsecured market in 2011. So there's a big change in that market. So what we're trying to understand here is what is that changes in behavior, sometimes induced by improvements in the regulatory framework. What does that do to how money markets trade? And so we look at the LCR can have effects on the non-operating deposits, and if there are appropriate effects. A non-operating deposit is not as sticky as a deposit that you have in there to cover some of the operations. So it doesn't receive the same favorable regulatory treatment in that. And for money funds and the structure of money funds were a big part, as you saw in real life, of the accelerant that went on in September 2008. So the SEC has been trying very, very hard to make changes to keep the good aspects of investments. Most people in this room probably have some investments in money markets without some of the undesirable things that can happen when there's instability in markets and people start to get unsure about the return of their cash. So they're putting necessary regulations there. We just have to observe that and see if it leads to any different trading in money markets. If you look at, I think, whether you can see that there. So if you look at figure 13, all right? So non-bank financial institutions are broadly money markets, so you can see how important they are in the overall money market of about $300 billion, the overnight unsecured market. And they're a big part of the tri-party market as well.
Okay, so questions from the audience? Anybody? Yeah, could you come up and stand at the mic and
Sure.
Identify yourself?
Hi, Matthew Bosler. I just had a quick question about
Bloomberg, right?
yes, from Bloomberg. The charts in your presentation, it seems like there's a bigger, fatter left tail in the distribution of Eurodollar trades post-liftoff relative to pre-liftoff versus repo and Fed funds. Do you have any thoughts on why that might be the case?
Yeah. So we're showing the first percentile. So if I could show you more detailed data, this thing would look incredibly smooth around the median. It turns out actually the variation around the median in the Eurodollar is much smaller than it is in Fed funds. So what you do see is in our data, some transactions at these very low rates. Now these are booked as Eurodollar transactions. We're not quite sure what those transactions are. So that's 1%. So of 250 billion, it's about 2.5 billion. Could be intercompany, could be something else. This is, we've been scrubbing this data, looking at it. It does seem to be a feature of the Eurodollar market. In the Fed funds market, what you'll still see, and it's the right thing to see, is some trading above 50 basis points. Because if you're a depository institution that's short of cash for a reserve requirement or just short of cash, you have to go out and borrow from another depository institution, and they're going to want more than 50 basis points to take that off their balance sheet because they could earn 50 at the Fed.
Any other questions? I've got I have one, that's
Okay.
all right, I'll take prerogative, which is completely for the students in the audience. I bet they would be interested, particularly since I see a lot of familiar faces amongst the students. I'm guessing that at least some of them, that they will be interested in hearing how you ended up in public policy, because it's not where you started your career.
So I started
how did you do it?
as an academic, like you did. First as a student, so you can get to the point. So lots of reasons to move into public policy, particularly in New York. It's fun working in New York because it's the center of with London, it's where the global financial markets are really transacted. New York Fed is particularly fun because we have the open market operations. We supervise the large banks. We have an active research group there. I'd say for me, I started out as quite academic when I was at the New York Fed, and then got more interested in the practical side of policy, which a lot of you get in your experience here. And one of the great things is just the diversity of viewpoints, diversity of training that we have, and that really helps us produce, I think, good public policy outcomes. So Laurie Logan, who's a graduate from 1999, is a person actually who thought of the overnight RRP facility over 3 years ago. And that's one part of it, thinking of it. And then lots of people with different backgrounds, operational backgrounds, theory-type backgrounds, knowledge of money markets contribute to how we formulated that and worked on it going forward. Yeah. Hey, Jonathan.
Hi, Jonathan Spicer with Reuters. Question, just follow up on the monitoring of the conversion of money funds to government only. On that, I guess I'm trying to get a sense of what exactly would be too much as far as this trend of conversions. Do you need to wait until after October when that SEC deadline comes in? And as a third, have you talked to the SEC about this problem?
So I don't think it's a problem. There are new rules that the SEC is going to have in place by October 2016. And the private sector has to look at their business model and decide what's best for them to do. The Fed is a large transactor with an important interest in money markets. We want the private sector to make the necessary changes that they need to make to their business models to ensure that they're providing good services within the Fed regulatory framework. And then we look at how we're going to operate to achieve what we're supposed to do. So the FOMC directs us to keep the Fed funds within the target range. And there are other things that they're interested in, as the speech discussed. We want to have, if we can, the lightest touch in markets possible. So we don't want our rather large footprint right now to be affecting the long run structure of U.S. money markets if we can avoid that. And with the overnight RRP facility, we want to be careful that it doesn't amplify some of the run risks that we saw in 2008. But we're not going to have a viewpoint as to what money funds should do. We're just trying to look at how we're going to implement policy subject to these two things where we're trying to basically do no harm, given how we implement policy.
Okay. All right, thank you. So I think we're about out of time.
Question?
So maybe you can follow up.
Katie
with
can
that
she can get one question.
No,
Okay.
okay,
Seeing
okay,
as
fine.
she's a journalist who was supposed to ask questions, they got to ask it, so it'd be fair.
Katie Byrne with the Wall Street Journal. This may be nothing, but I saw a reference to possible revisions to foreign currency investment guidelines at the desk in recent minutes, and I was wondering if there was a motivation for the change in the framework, and if you could detail what changes you might be making, and when was the last time you made an overhaul like that?
So that's for people who can really read the FOMC minutes with a lot of care. So we're constantly looking at various parts of the operations we do. And people focus on the domestic side. We have a foreign operations that we'd also do out of New York. That used to be a big part out of what we did in New York. It's become a much smaller part of what we do. Yeah, trust you. And one of the things that we're constantly doing is re-looking at how we might manage those foreign reserves. So we manage just under $20 billion of foreign reserves for the FOMC and about the same amount for the U.S. Treasury in the ESF. Last year, we extended the duration limit on that because some of the interest rate dynamics we were seeing, particularly in Europe, where they'd gone to negative rates, and we had to think about how to maintain the principal as well as the liquidity in that portfolio. So what you're just quoting there is part of that work that we're looking at that. We also want to look at the foreign documents in the same way that we did with the domestic documents, where you can read the domestic documents and they should be more understandable, the authorization, than they were prior to last year. I mean, Trish, you probably remember the domestic authorization. The foreign authorization is in three separate documents, so we're just looking at how to have that easier to understand to the public.
Great. Thank you all very much. Thank you, Simon.